everybody. Well, welcome back to the channel. In this video, I'm going to be going over strategies, tips, loopholes that franchisees can implement into their business. And if they do, they're going to reap really big, up to 35% reduction in what they pay at the end of the year. Because you own a franchise, you technically own a business, and that could be an LLC, that could be a corporation, it may be an S Corp. There's different structures, but when you go from being a W-2 employee to now a business owner, there are going to be strategies, things that you can do from a tax perspective that you're just not familiar with. And by not knowing these strategies, you are guaranteed to pay more than your cohorts, your peers in taxes, because they are using these strategies. So you want to be aware of, like, what can you do to really move the need on what you owe in taxes. The first strategy that I want to go over is called the Augusta loophole. Now, what the Augusta loophole is, it is a tax loophole that allows you as a homeowner or even as a renter to sublet out your home. And that could be for like a short-term rental, that could be for a number of different things. But the result would be as long as the number of days that you rent your home out for is 14 or less in a given year, in an entire year, 14 or less, then that income to you as the renter, as a person renting their home, is tax-free. It's not income like your job would be, or the net income from your business. The way we use this as a strategy for franchisees is to rent your home to who? To your business. And why? For business meetings. That could be board meetings, that could be meetings with employees, with customers, just the owners, to go over things related to the business. You have to document the rate that you use, the rental rate. It has to make sense. You can't say like $5,000 a month or something, a blanket number. You have to do research. You have to look at comps and see what makes sense. And the other thing you need to document is what you talked about. You should be keeping a set of minutes to document what was discussed that day, again, to show more evidence of that there was a business purpose for meetings. As long as you do that, again, that's 14 days times your rental rate as tax-free income to you as the owner and deductible expense to business. So it really is a double whammy of you getting money in your pocket and the deduction on the business. Now, the second strategy I wanted to go over is called the accountable plan. This is a tax reimbursement plan, or a taxable reimbursable expense plan. Throughout the year, you might be spending money on certain things, on travel, on meals, things that on their face could be confused as either a personal expense or a business expense. Now, what the accountable plan does is creates a policy in your franchise, in your business, to say what is reimbursable: the meals, the travel, anything else that you spend on the personal side, the miles, the miles that you drive your car, anything that you spend personally can be reimbursed. So as long as you have that plan in place and follow a procedure for reporting what those reimbursable expenses are, then you can achieve a deductible expense on your franchise, on the business, but the reimbursement is not income to you. It's just a reimbursement of expenses paid. Number three is a little bit more advanced. It is not going to make sense for everyone, but it's called a cash balance plan, which is a type of a pension plan or defined benefit plan. So this is those traditional pensions versus what we have today, the 401k, the defined contribution plan. The pension still exists, and you can create it in your franchise. And depending on your income, depending on how high you're expecting your taxes to be, you could contribute far beyond what you could do with like a 401k. A 401k, it goes up a little each year, but it's in the 50 or 60k. With a cash balance plan, we actually have a client that we just helped contribute $188,000 in 2023 to their plan, and that created the deduction and save them $76,000 off of their tax bill. So that's the impact that a cash balance plan can have. Now, it's more expensive to create and maintain than like a 401k or an IRA, being the cheapest and easiest to set up. I think I'll do a video completely on retirement plans and what options make sense for a franchise owner. But for now, the cash balance plan, I wanted to make you aware that exists. Another type of retirement plan for number 4 is called a solo 401k. So if you are a sole proprietor, you might have an LLC and you're the sole owner and you have no employees, you can create what's called a solo 401k. And it being pretty cheap and easy to set up, you can reap a lot of the benefits of having a 401k, like being able to contribute a large amount each year, having a profit sharing component where the business can contribute on your behalf, where all of that benefit would go to you directly. You know, if you're in like the 150k income range, that's more your speed, like a solo 401k. Again, if you don't have employees. If you do, you might do a traditional 401k, which again, I think I'll do a video on retirement plans. But if it's just you're in that low six figure income range or high 5, then a solo 401k could make a lot of sense. Number 5, bonus depreciation. So if you buy assets for your business, an asset being an item, a good that is going to lend itself to you generating more revenue. That's what an asset is. If you think cash, vehicles, your franchise fee, your right to use the franchise, that's an asset. That's called an intangible asset. So assets are these items that help you kind of propel forward, and specifically we're talking about depreciable assets, or assets that over time kind of wear down, like cars, buildings, equipment. Assets like these can, in the year that you either buy or finance them, can be not entirely expensed. They actually could be. For this year, it's 60%. You can take a 60% immediate deduction off of that, the amount that you spent for that asset, for the equipment, for the vehicle, the year that you buy it. Now, there are some special nuances here, like for a vehicle to be able to do this, it does have to have a GVWR, or a gross vehicle weight rating of 6,000 pounds or more. So that's a very specific requirement. But for the majority of assets, you will be able to do this. Now, it's 60% in 2024. That's decreasing to 40% in 2025. 20% in 2026, and then phased out. As of the time I'm making this video, this is June 23rd of 2024. So that can change. I did see that there is a bill that they're trying to reinstate it back to 100% and retroactively as well. So that could apply. So we just have to keep an eye out on that. Another strategy that can make sense is hiring your kids into your business. Now, typically, you're not going to hire a minor to do work in your business, but as parents of kids, you do have the ability to have your kids work in your business and to be paid, just like any other employee on payroll. Why would this make sense? Kids can be paid. It's up to about $14K in 2024 per year, where if you pay them that amount or less, all of that income to them is tax-free. That amount, the $14K per kid per year, is creating a deduction in your business, and so that's reducing your tax. So if you think about your family as like a household, you're bringing in more money by splitting up the income, a little bit amongst your kids, and you could even go beyond that. You could pay them 20 or 25K. and their rate might be like 10% and your rate is 25 or 30%. So you'd still see a benefit there. Another benefit to hiring your kids is starting to teach them about responsibility and with finances, how to earn money and save it, where to put the money. As a kind of a ricochet effect, or another step that you can take with this strategy is to then open up an IRA for your kids. So now imagine that your child is starting to put away money for retirement into an IRA. If they can build that from the age of 10, instead of a lot of us from like the age of 25 or so, depending on when you start in employment, that's, they might have a 15-year head start on the typical person putting money away into retirement. So there's a lot of good that you can do with that, like this and the other strategies that I spoke about. Work with your tax professional before you start doing any of this. You have to consider your specific state, the HR laws of your state. You have to consider if this even makes sense. You might, if you really look at your numbers, you might not benefit that much from these things yet, but a year from now, you definitely could. So it doesn't hurt to be aware of like, what are the different things that you can do. And by the way, we're going over just a few in this video. There are dozens and dozens and dozens of strategies just like these that you could be doing in your franchise every year to greatly reduce what you're paying in taxes. One last strategy to go over, and this is around how you structure your business. So there's a common question that we get: what's an S Corp? Why does it make sense? When does it make sense? And it is a really good question, and there is truth. That's why it's on this list. There's a benefit to being an S Corp for taxes, and that is if you have an LLC, and especially if you're a sole owner, if you're a single member LLC, you're paying something called self-employment tax on your income, and that's a 15.3% on almost all of the income of LLC. So if your LLC did 100K this year, that could be about 15 grand. If you did 200K net, that would be about 30 grand. And so on. So it is a pretty big tax, and it doesn't matter if you're a single member LLC. If you pull the money out, if you leave the money in the LLC, you're still paying self-employment tax on the earnings of the LLC. That flows through right to yourself no matter what. With an S Corp, it's different. It's a little bit more nuanced. So instead of all of that 100% of the income of the business being exposed to self-employment tax, with an S Corp, your income is actually split into two different buckets. The first one being the salary that you earn as an employee as doing the work, and then the second one being the distributions that you earn as the owner. So whatever's kind of left at the end of the year, net to you recognize. Again, it doesn't matter how much money you're drawing out or leaving in. It's just your income is the salary that you're taking as an employee that's doing work, and everything else net goes to you as the owner. The trick here, the benefit here is, of those two buckets, only the salary are you paying that full 15.33% self-employment tax on. On the employer distributions piece, you're only paying half of that. So imagine if you had a distribution that would have been taxed, let's say 100K, instead of paying 15 grand, you're paying about 7.5. In that case, it makes sense. Now, if your income is zero, if you're operating at a loss, well, then it really doesn't matter whether you're a single member LLC or an S Corp. You're paying nothing in taxes because you don't have any income. So it really doesn't begin to benefit you until you are making 50 or 75. It does depend again on the state you're in. It depends on a number of things, and you want to consult with your CPA or tax your professional. If you do go the S Corp route, there is more compliance involved. You do have to take a salary. It has to be a reasonable one. So if you didn't have a payroll before, you're going to have that, and all of the compliance filings that go along with maintaining that. And then your taxes would change. As a single member LLC, you don't have a separate return for your taxes. You just have your 1040 and then your Schedule C. As an S Corp, you still have to do your 1040, and you have to do an 1120S, which is a totally a different return. So your tax tax compliance is going to get a little more involved and a little bit more expensive. That's why the timing of when you do that conversion is really important. That's all I had for this video. So again, those are just a few things that you can do throughout the year to reduce your taxes. If you're concerned about a high bill this year, if you paid a high bill the previous year, if your current professional hasn't really mentioned anything that I just said to you, we're happy to connect and see if there's anything that we could do, if there's, or uncover any other strategies that you might not be doing can really move the needle and reduce your bill. Thank you so much for watching. I look forward to seeing you in the next one.